Without tariffs, this country would be in such trouble, as they were for many years. That's why we owe $38 trillion. And one of the things we're going to do, we're going to issue a dividend to our middle income people and lower income people of about $2,000. And we're going to use the remaining tariffs to lower our debt. We're going to be lowering our debt, which is a national security thing. So we're doing a lot of good work. And the numbers were reported so incorrectly. The real numbers are trillions of dollars have been taken in or gotten in terms of investment from the tariffs.
This is a crucial update regarding the promised $2,000 dividend payment that has been discussed widely. I want to give you the facts, look at the arithmetic, and analyze the likelihood of these payments actually hitting your bank account based on the timeline and funding mechanism being proposed. President Trump has made a definitive statement regarding this proposed payment. On November 9th, he stated clearly that a dividend of at least $2,000 per person, excluding those with high incomes, will be paid to everyone. It is important to note the language used here. He did not suggest this was merely an idea or a proposal being considered. He committed to delivering it. Furthermore, the commitment stated was for a minimum of $2,000, implying the payment could potentially be higher, perhaps even $2,200 or $2,400. The very next day, the mechanism for this payment was clarified. President Trump wrote that all money remaining after the $2,000 payments are made to low and middle income USA citizens, money derived from what he describes as massive tariff income pouring into our country from foreign nations, will be used to substantially pay down the national debt. Now, we need to address that fundamental claim head on. The idea that massive tariff income is pouring into our country from foreign nations. The reality of how tariffs work is often misunderstood, and I need to clarify who truly bears the cost of these taxes. Contrary to the idea that foreign countries pay the United States government tariffs, they do not. When merchandise is imported into the United States, the fee charged, which is the tariff, must be paid by the American importer of record for that merchandise. This is codified in federal law. To illustrate this, consider a large American retailer importing goods from overseas. That retailer, being the American importer, pays the tariff. This tariff is, in essence, a tax on that imported product. The exporter, the foreign country or company, is not the entity paying that tax. Do you think that the American importer paying this significant tax is simply going to absorb the cost without passing it on? Logically, the answer is no. These large corporations have shareholders they must satisfy, and they are committed to protecting their profit margins. When tariffs increase their operational costs, retailers are compelled to raise the prices consumers pay to offset the tariff expense. Many of the largest U.S. retailers have already done this. Companies like Walmart and Target, as well as giants such as Amazon, Nike, Adidas, Home Depot, Macy's, AutoZone, and Best have already raised prices on goods that are affected by these tariffs. Ultimately, the tariff, which starts as a tax on the importer, is passed directly onto us, the U.S. consumers. We're the ones paying the tariff, not foreign governments. This dynamic holds true for necessary imported goods, including food. It is vital to remember this context when looking at government reports on consumer prices. The government reports that the general rate of inflation is currently around 3%. However, when you look specifically at imported products, the impact is far greater. For example, the price of bananas is up by approximately 8% compared to 12 months ago, and the price of coffee has skyrocketed by 40%. This rapid escalation in price for imported necessities is a direct result of the reliance on imports and the impact of the tariffs. In fact, the rising prices caused by tariff-affected items have become so severe that certain tariffs had to be cut. This brings us to the core issue, the arithmetic of the proposed $2,000 stimulus payment. President Trump suggests the tariffs are bringing in a massive amount of money, enough to fund a minimum $2,000 payment per citizen, and then use the substantial leftover revenue to pay down the national debt. Let us analyze the actual figures involved. For the current calendar year, 2025, The revenue collected from tariffs is significantly higher than in previous years. As of November, the amount collected stands at $228 billion. Factoring in the remaining months of the year, the final figure for the entirety of 2025 is expected to come in slightly under $300 billion. The question is simple. Is $300 billion enough to fund the $2,000 payments and still have a substantial amount left over to reduce the national debt? The economics of this proposal appear highly challenging based on the current revenue figures. It is fair to ask how the American public views this proposal. In short, most Americans are skeptical about the likelihood of receiving this $2,000 check. Financial markets reflect the skepticism. For example, the market currently believes there's only 7% chance that this $2,000 payment will be issued in the last month and a half of 2025. In my opinion, expecting a payment of the size to be issued so quickly is highly unrealistic. Any such large expenditure requires a vote through Congress. As we have seen in recent years, politicians often struggle even to pass legislation required to simply keep the government operating. Attempting to approve a $600 billion stimulus measure in such a short time frame is immensely difficult, bordering on the impossible without a massive economic emergency. The probability for this year should be closer to 0%. Looking further ahead, the market suggests there's a 27% chance that President Trump could issue the $2,000 check by March 31st of the following year. However, the only realistic scenario for the government to issue a stimulus check of this magnitude in 2026 is if the economy faces a catastrophic downturn or requires a massive financial bailout that threatens the entire system. And even in a bailout scenario, history has shown us the potential outcome. When the government issues bailouts, the everyday American citizens tend to receive only minor assistance compared to the immense sums given to major institutions or the ultra-wealthy. We saw this previously where large businesses received massive loans, sometimes totaling up to $100 million, while common Americans received checks of $1,400. Furthermore, we must consider the inescapable consequence of funding a program this large: inflation. If we do receive a $2,000 check, we will bear the consequences in the form of increased costs across the economy. And remember, the stimulus check will likely be minor when compared to the vast financial assistance received by the wealthiest individuals. President Trump remains committed to the idea, however, consistently stating that he will deliver on this promise. He justifies the financial feasibility by counting potential economic investments in the manufacturing industry over the coming years, suggesting the tariffs are bringing in trillions of dollars. But let us examine the reality of the manufacturing sector. Tariffs were intended to revive American manufacturing, yet since the implementation of some of these tariffs in April, the manufacturing sector here in the U.S. has actually lost more than 50,000 jobs. Finally, we must address a critical legal threat facing the entire funding mechanism. Typically, tariffs can only be implemented through a vote in Congress. President Trump implemented these tariffs without that vote, and they are now being challenged in the Supreme Court. If the Supreme Court rules that President Trump's tariffs are illegal and must be voted on by Congress, then most of the current tariffs could be struck down. In that scenario, the revenue brought in by the tariffs would dramatically decrease, potentially falling to under $100 billion. If the revenue drops to under $100 billion, it makes the funding gap for the $600 billion payment even wider, making the dividend payment mathematically unsustainable through the current proposed funding source. This situation presents a clear conflict between a large promise and the current financial, legal, and economic facts required to deliver it. I will continue tracking this situation closely for you and provide updates as they become available. If you found this explanation helpful, please consider liking this video. Don't forget to subscribe to the channel for more straight talk on your finances and hit the notification bell so you don't miss our next analysis. Thank you for your time, and I'll see you soon.